Hi, Gabriel Josiah here again. Welcome to another essential lesson in financial management. Right now, we are focusing on trade payables turnover ratio, a key metric that measures how efficiently a company pays its suppliers of goods or suppliers for goods and services purchased on credit. This ratio not only sheds light on a company's cash flow management, but also reveals its payment habits and relationship with suppliers or vendors. Whether you're gearing up for exams or enhancing your professional toolkit, mastering this ratio will empower you to make informed decisions in your future accounting career. Let's dive in and explore its formula implication with a graphical example like we've always done in previous sessions. Okay, let me share my screen as our custom and let's look at the notes descriptively on how this ratio is. All right, this trade payables turnover ratio measures how quickly the company pays off suppliers, creditors for goods and services purchased on credit. So just like we saw in the last ratio, receivables are those goods and services owed the company, while payables in these turnover ratios are goods and services the company owes suppliers and vendors, who are mostly other companies that provide these goods and services to the company. This ratio provides insight into a company's payment habits and the efficiency of its cash flow management in relation to the obligations or to its obligations to suppliers. The formula is clear on the screen. It's stated as the net credit purchases divided by the average trade payables. Don't forget that the reverse of this is the liquidity ratio called the trade payables period that measures in days. How many days quickly or swiftly it takes the company to pay its suppliers. This is very important. So the efficiency ratio is just the reverse of that liquidity ratio, telling us how many times the company pays. And you just reverse the formula. In the other liquidity ratio, you have the average trade payables as the numerator and the net credit purchases as your denominator. And where you don't have net credit purchases stated clearly in its financial statements, you use your cost of goods sold. So your credit purchases is the total purchases made on credit, excluding cash purchases. While your average trade payables, it's your beginning purchases, credit purchases, while your ending purchases, both are added together, divided by 2 to have the average for a particular accounting period. Okay, so like is our custom, let's use the same example we've been using, Shalabutu Nigerian PLC, to look graphically on how to calculate these ratios. So we have our sales for the period. I beg your pardon, we're not using sales. We have our purchases. You can see it. We have our purchases for the period as 1 billion naira. Okay, so there's a caveat or a note here that states of the total purchases yearly, 70% was cash. Don't forget, we just spoke to that. We don't use the cash to calculate this ratio. We use the credit. So we take 30% of this purchases, which is 1 billion naira, to calculate this ratio. So from our formula, we have it as our net credit purchases divided by our average trade payables. So very well, let's pick our credit Let's put our purchases first. If you have your calculator, just follow. So pick our credit, our purchases figure first. So let me take my provision to adequately show what I'm calculating. So as you can see on my screen, we have the purchases figure. We want to pick, we want to get the credit of these purchases, which is stated in the question by the financial statements as 30%. So you just calculate 1 billion naira by 30%. Very simple. 30%, which is 30, and you have it as 300 million naira for credit purchases. Very simple. So let's go now and pick our average payables or average payables for the period. So in our current liability section where this is domiciled, we have it as our trade payables from the beginning, which is the 1st January, 31st December. So we have it as 150 and 180 respectively. 150 and 180 respectively. So bring that here, categorically stated as the trade payables. So let me stratify that. It's opening. So say this is closing. So let's sum it up. We have it as 330 million trade payables. So let's have the average trade payables, which is expressed as this 300 divided by 2. Should be familiar with this right now. This is 165 million. So what is our trade payables turnover ratio? Let's calculate that out. Formula states our credit purchases divided by average trade payables. We have it as 1.18 times, almost 2 times approximately. So 1.81 times positive. So this is how many times it took Sharobutu Nigerian PLC to turn over their trade payables in the year 2020. So almost twice, which is positive and commendable. So what does that mean? What does that mean? Now it means that the rate at which the company turns their payables or pay their creditors in the year is what this means. So in the case of Sharobutu, they were able to offset their bills almost twice, 1.81 times in the year 2020. So this suggests, when it comes to a high ratio, that the company is paying the suppliers promptly or on time, while a lower ratio indicates slower payments or longer credit terms with suppliers. What's the implication? A high trade payable turnover ratio suggests that the company is managing the supplier payments effectively, possibly taking advantage of early payment discounts. So where you have the ratio higher than 1, 2, 3, 4, this is possibly the implication. Company is taking advantage of any discounts and other terms that favors the company. However, excessively high payments might limit cash availability for other operational needs. This is a bit risky. So balance needs to be struck and provided in such context. While a low ratio may indicate that the company is delaying payments, possibly to conserve cash, but could strain relationship with suppliers. What is the cause and effect? So a high payables turnover causes quick payments to suppliers, favorable payment terms, discounts, and other rebates, or efficient cash flow management. So this is the cause of a high trade payable turnover. While the effects, strong supplier relationships, potential access to discounts, but reduced cash flexibility. So these are the effects of a high trade payables turnover ratio. While the causes of a low one is delayed payments to suppliers, extended credit terms, or cash flow constraints. And the effect is clear. You strain the relationship with your suppliers, which in future may not be able to provide raw materials or services for you to in turn generate revenue. Also potential late payment fees, but more restrained cash for other operations. So these are the effects of low trade payables turnover ratio. So in conclusion, this ratio helps assess how efficiently a company manages its obligations to suppliers. The high one demonstrates timely payments for goods, supplier, and managing them efficiently. So the relationship is not strained when you have a high ratio. This demonstrates that practically. Though it may reduce cash flexibility, but then it's always the best to pay on time. While a low ratio can provide short-term liquidity relief, but then you are straining your relationship with suppliers, and you may have supplier issue and stock out costs, materials, purchase issues with your vendors. So balancing payments to maintain both good supplier relations and cash availability is crucial for smoother operations. So chartered accountants, finance professionals should ensure they master the skill of balancing this ratio or these conditions to ensure that there are no hitches as it comes to such. All right, so having looked at this ratio, now we understand how to calculate it and how it works. So we've unraveled the complexities of the trade payables turnover ratio, and you can see how it plays a pivotal role in assessing a company's financial health. A high ratio signifies prompt payment and solid supplier relationships, while a low ratio may offer temporary cash relief, but can strain those very good relationships you have with your suppliers. As you continue your journey in accounting, remember that balancing timely payments with maintaining cash flow is essential for operational success. If you found this content valuable, don't forget to like, subscribe, and click the notification bell for more insights. Keep exploring the world of finance and refining your expertise. See you next time. Until then, bye for now.